Listen, brother, one of the most common questions people ask when they start thinking about investing is simple. Should I buy gold, should I buy silver, or should I invest in the stock market? People want one clear answer because choosing feels safer than managing complexity. But here is the reality most people discover too late. Smart investors usually do not choose only one. They build a structure where each asset plays a different role. Think about two people who start investing at the same time. They earn similar incomes, live in similar cities, and both want financial security. Both of them are serious about building a stable future. The first person wants certainty. He wants something he can understand quickly. So he chooses only gold because gold feels safe and familiar. Every month he buys a small amount of gold and stores it carefully. He likes knowing that gold has been trusted for centuries. Seeing physical metal makes him feel protected. The second person thinks a little differently. He also respects gold, but he does not expect one asset to solve every problem. Instead of searching for the perfect investment, he focuses on building balance. He keeps some gold as protection. He adds stocks for growth. He includes a small amount of silver because it behaves differently in certain economic environments. 10 years later, both investors feel they made reasonable decisions. Neither of them acted irresponsibly. Both believed they were protecting their future. But their financial situations start to look very different. Because investing is not only about choosing good assets, it is about how those assets interact with each other over time. Gold has a long history as a store of value. People trust gold because it cannot be printed or created easily. It has survived wars, crises, inflation cycles, and political change. When uncertainty increases, many investors feel more comfortable holding gold. Gold often becomes more attractive when people worry about the stability of currencies. It behaves like a financial insurance policy. But gold also has limitations. Gold does not produce income. It does not create cash flow while you hold it. If someone invests only in gold for decades, their purchasing power may stay stable, but their wealth may not grow as much as other investments. Protection alone does not always create expansion. Now think about stocks. Stocks represent ownership in real businesses. Businesses create products, services, innovation, and economic growth. When companies grow, shareholders participate in that growth. Stocks historically have produced higher long-term returns than many other asset classes, but stocks also move up and down in the short term. Some years the market performs strongly. Other years it experiences corrections or uncertainty. This volatility can make investors uncomfortable. Silver sits somewhere between these two worlds. Silver has industrial uses and is influenced by technological demand. It also shares some characteristics with precious metals like gold. Silver can sometimes move more aggressively than gold. It can react strongly during economic expansion or contraction. Because of this, silver often behaves differently than stocks or gold. Now imagine two neighbors discussing their investments. Both started saving money around the same age. Both wanted stability and long-term growth. The first neighbor kept almost everything in gold. He felt confident because gold rarely loses its long-term relevance. He avoided market volatility as much as possible. The second neighbor built a simple allocation. He placed part of his money in stocks. He kept some gold as protection and added a small portion of silver. During certain years, the stock market performed very well. During other periods, gold performed better. Sometimes silver reacted more strongly than both. Because the second investor owned different assets, his portfolio did not depend on one outcome. He did not need to predict which asset would perform best every year. He allowed diversification to reduce uncertainty. This approach reduces emotional pressure. When one investment moves slowly, another may perform better. the portfolio becomes more stable over long periods. Many people think investing success comes from predicting the future correctly. But in reality, most experienced investors accept that predicting consistently is extremely difficult. Instead of guessing, they prepare. Imagine a simple table with three objects: a gold coin, a silver coin, and a chart representing the stock market. Each object responds differently to economic change. Inflation affects purchasing power. Interest rates influence borrowing and spending. Innovation changes how companies grow. Because different forces influence each asset, combining them can reduce dependence on a single scenario. Diversification does not guarantee profits, but it can reduce exposure to unexpected outcomes. Consider another example from everyday life. Two friends receive a bonus from work at the same time. Both want to use the money responsibly. One friend decides to hold everything in cash for flexibility. He believes having immediate access is always the safest option. He prefers not to take any risk. The second friend keeps some cash but allocates the rest across different assets. He understands that inflation slowly reduces the purchasing power of idle money. He wants his money to remain productive. 5 years later, their financial situations feel different. The first friend still has the same nominal amount of cash, but prices have increased. The second friend experienced market fluctuations, but overall, his diversified investments created gradual growth. He accepted short-term movement in exchange for long-term opportunity. Now think about uncertainty. Economic cycles are not predictable in the short term. Markets move because of thousands of variables interacting simultaneously. Some years inflation increases rapidly. Other years technological growth drives stock market expansion. Sometimes geopolitical events influence commodity prices. Because uncertainty cannot be eliminated, smart investors build structures that can adapt. They do not rely on one scenario being correct. They prepare for multiple possibilities. This does not require complex strategies. Many investors simply divide their capital into categories. Each category has a purpose. Stocks for growth potential. Gold for stability perception. Silver for additional diversification exposure. The exact percentages vary depending on personal preference. Some investors prefer more growth exposure. Others prefer more stability. The key idea is not the precise allocation. The key idea is understanding that each asset behaves differently. Expecting one asset to perform perfectly in every environment creates unrealistic pressure. Another common misunderstanding is believing that diversification requires constant trading. In reality, many long-term investors adjust their allocations gradually. They do not react emotionally to every market movement. Instead of chasing trends, they focus on consistency. They invest periodically. They allow time to influence results. Imagine planting 3 different types of trees. Each tree grows at a different speed. Each responds differently to weather conditions. One tree may grow quickly during warm seasons. Another may grow slowly but remain stable during harsh climates. Over time, the garden becomes more resilient. Investing can follow a similar principle. Combining assets with different characteristics can create balance. Balance can reduce the impact of extreme outcomes. Another perspective to consider is psychological comfort. Investors who hold only one asset often feel strong emotional reactions when that asset fluctuates. Seeing significant changes can influence decision-making. Diversification can reduce emotional extremes. When investments move differently, the overall portfolio may feel more manageable. Stable behavior can support rational thinking. This does not eliminate risk. All investments involve uncertainty. But structured diversification can distribute exposure. Now imagine 2 identical professionals starting their investment journey at age 30. Both save consistently for 20 years. Both remain disciplined with their approach. The first investor chooses only one asset class. He believes simplicity requires choosing a single direction. He avoids diversification. The second investor builds a small system. He allocates resources across different asset categories. He allows each category to contribute differently over time. After 2 decades, both investors accumulated capital. But the investor with diversified exposure experienced fewer extreme fluctuations. His financial experience felt more stable. Another important factor is behavior during market stress. Periods of uncertainty often create emotional reactions. Investors may feel pressure to act quickly. When portfolios include different asset types, sudden movements in one area may not define the entire outcome. This can reduce the impulse to make reactive decisions. Long-term strategies benefit from stability. Smart investors often accept that uncertainty will always exist. Instead of attempting to remove uncertainty completely, they design systems that tolerate it. Tolerance creates flexibility. Flexibility creates options. Options create resilience. Resilience supports long-term continuity. Consider how businesses manage risk. Many companies diversify revenue streams. They do not depend on a single product. Investors can apply similar logic. Combining assets with different economic sensitivities can create structural balance. Balance supports sustainability. Gold, silver, and stocks each respond to different global forces. Technological innovation influences stocks. Industrial demand influences silver. Monetary policy and currency confidence influence gold. These forces rarely move in identical patterns. Differences create diversification benefits. Another advantage of diversified investing is decision simplicity. Instead of constantly searching for the perfect moment, investors follow a structured plan. Consistency replaces guesswork. Some investors invest monthly regardless of market conditions. Others rebalance occasionally to maintain their preferred structure. Both approaches emphasize process over prediction. Long-term investing often rewards patience. Short-term outcomes vary significantly. Time allows systems to operate. This does not mean investors ignore information. It means they avoid reacting impulsively to every headline. They recognize that markets reflect complex global dynamics. Imagine observing the financial journey of 2 siblings. Both start with similar resources. Both receive similar financial education. One sibling constantly searches for the best single investment. He frequently changes direction. He reacts strongly to market news. The other sibling focuses on building a simple, diversified structure. He adjusts slowly. He prioritizes continuity. After many years, both siblings learn valuable lessons, but the investor with structured diversification often experiences more stable progress. Consistency influences cumulative results. Diversification does not eliminate downturns. It distributes exposure. Distributed exposure can reduce concentration risk. Many experienced investors describe diversification as preparation rather than prediction. Preparation accepts uncertainty. Prediction attempts to eliminate it. Financial markets involve uncertainty by nature. Expecting complete predictability can create frustration. Accepting variability can support discipline. Ultimately, gold, silver, and stocks are not competitors. They are tools. Tools perform different functions. Using multiple tools can expand capability. Limiting tools can restrict flexibility. Flexibility supports adaptation. Smart investors often focus less on choosing one perfect asset. They focus more on constructing balanced systems. Systems operate even when emotions fluctuate. The goal is not perfection. The goal is participation combined with structure. Structure supports continuity. Over long periods, structured investing can produce meaningful results. Time interacts with consistency. Consistency interacts with allocation. Allocation influences exposure. Exposure influences outcomes. Outcomes influence future decisions. Investors cannot control every market movement, but they can influence how their capital is positioned. Positioning affects experience. When uncertainty appears, diversified investors often feel more prepared. Preparation reduces pressure. Reduced pressure supports clarity. Clarity improves decision quality. Better decisions influence long-term results. Long-term results influence financial flexibility. Gold, silver, and stocks each represent different economic behaviors. Combining them can create balance. Balance can support resilience. Smart investors do not always search for the single best asset. They design structures that can function across changing conditions. Functionality supports sustainability. Over decades, sustainable strategies often outperform impulsive adjustments. Time rewards discipline. Discipline supports continuity. Ultimately, investing is not only about selecting assets, it is about understanding how assets interact. Interaction shapes experience. When investors recognize the role of diversification, decision-making often becomes calmer. Calm strategies can remain consistent longer. Consistency influences outcomes. Gold, silver, and stocks do not need to compete. They can cooperate inside a structured allocation. Cooperation creates balance, and balance, over long periods, can support financial confidence.